My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to save you a little money. My job is not just to entertain, but to explain and teach you about days like today. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. The action in the 10-year Treasury speaks louder than words. And that's my takeaway from today, where traders sold anything with an ounce of economic sensitivity, because Treasury yields plummeted almost out of nowhere, signaling that what could be a dramatically weaker economy ahead. And that's how the Dow sank 495 points, S&P plunged 1.37%, and the Nasdaq plummeted 2.3%. Almost no sector was spared, though, including the recently beloved small cap. In fact, the Russell 2000 got hit the worst, down over 3%. What a turnabout. It almost seemed like the death knell to last month's big trade. I always tell you the bond market is much bigger and much more powerful than the stock market. Bonds can call the tune in the stock market at pivotal times. Today was one of those pivotal times, because the 10-year Treasury is a very visible piece of paper to a lot of the big investors in the world, and it plummeted in yield, crashing through the 4% level to 3.98%. That's the lowest it's been since February. I know it doesn't sound like much, but it triggers a lot of other things. Why does it matter? Because the 10-year is the sum of all of our fears about the economy. When the economy is too hot, when inflation's roaring, the 10-year tells the tale and plummets in price, sending yields soaring. That's usually a sign the Federal Reserve needs to rein in inflation by raising interest rates. But you know what? It can be bad, too, when rates fall. When the 10-year yield crumbles, when it goes down very hard, very fast, that tells us the Fed better get started cutting the darn rates. In fact, it makes them look ill-advised for not cutting at yesterday's meeting. And that's what caused this decline. To me, today's terrible action in stocks was a function of the Fed not cutting rates yesterday at that Federal Market Committee meeting. The slowdown in the economy, the brown shoots, as I call them, has gotten much more palpable. They've turned into brown fields, with whole sectors starting to lie fallow. Yes, both the 10-year Treasury and the echoing stock market are saying the same thing. Jay Powell, you got this one wrong. You should have moved yesterday. September's too late. The evidence is too stark. How did you miss it? What were you listening to? Didn't they see the 10-year Treasury signaling economic danger? All right. Take a step back. The Fed's always fair game for criticism. But I feel they never get enough credit for doing anything right. I mean, the second guessers will be shamed if we get a strong employment number tomorrow morning. Wasn't it enough that Jay Powell said, look, they'll cut rates in September if the economy weakens? Chiding this Fed feels like a mistake. Inflation seems so intractable for so long, and now they've got it on the ropes. Plus, the soft economy is brand new, for heaven's sake. Last year at this time, there was almost universal criticism that the Fed was powerless to tame inflation, was too embedded. So I have better things to do with my time than lambaste the Fed chief for conceivably letting the economy wither for 7 more weeks. Of course, Powell wants to give it more time. He lived through the 70s, so did I, when the Fed would cut rates every time the economy started slowing, and then inflation would roar back again. He's a thoughtful, considered man in a world of thoughtless traders who do not get the consequences of moving too fast to bring rates down while inflation's still kind of hanging around. Plus, it's more than a little foggy out there. The slowdown isn't all that visible. Hey, last night, Meta Platforms reported an extraordinary quarter, in large part because it's been able to make its targeted advertising more efficient than ever. Advertising aimed at 3.27 billion daily average users. Holy cow, active users, I should say, which is up an astounding 7% year over year. Meta's spending a huge amount to have enough computing power, and CEO Mark Zuckerberg says he'll shell out maybe 10 times that for the next generation of its large language model infrastructure because the opportunity is so enormous. More on that later. After the close today, though, we got the other side. 2 other Mag 7 players that didn't deliver. Amazon, well, let's say the results were imperfect. Sales came in light despite real strength at Amazon Web Services. Earnings were better than expected, so the revenue guidance was weak, although they tend to always do the guiding very conservatively. Amazon's got to keep spending on compute, if only to keep up with Alphabet and, more important, Meta and Microsoft. Apple, though, put a clean top and bottom line beat despite severe weakness in China. Market's so negative on tech, they're not going to give Apple the benefit of the doubt. They never do. Of course, we got another story from other tech companies. I interviewed Rene Haas, CEO of ARM Holdings, the gigantic semiconductor design company. I did it this morning, and he talked about there was weakness in the Internet of Things. Huh? That's industrial tech. News reverberated throughout lots of tech, including Micron down 7.5%. Texas Instruments down 5%. Semiconductor capital equipment giant Lam, they put a good quarter, left people feeling a little bit queasy, though. And you know what? After an historic run from 574 last October to 1,133 weeks ago, well, that's how you get a 10% haircut. Then after the close, Intel, a company I've warned you again and again and again about, including yesterday. Well, they missed their quarter on all fronts, and they suspended their dividend. It is not safe. Tech's been a bastion of strength for so long, but now that bastion seems to be on the ropes, too. Last night, I talked about how there's been a downturn in discretionary spending. This morning, Wayfair Furniture reported a weaker than expected quarter. And more important, they said that this environment is like the Great Recession. We've heard from that refrain from RH's Gary Friedman. His stuff's pretty expensive. I mean, Wayfair's everyman. Jay Powell doesn't care if RH hurts customers. You can't afford it. You can't afford the customers. But Wayfair is much more bargain-oriented. That means widespread pain.
The House of Pain.
Travel's been one of the true bright spots in the economy, but yesterday Marriott says it's seeing weakness in America. I wouldn't normally worry, but today MGM Resorts said it was concerned about flagging advanced sales for its Formula One race. Remember that? That was such a huge hit. The rooms went to absurd levels. And maybe that's what's happened. That's why the stock's down 13% today. You have to wonder if it's a big deal. I don't know. I call it disconcerting. Of course, there are other signs of weakness that we've obvious. China. I mean, one more horrendous day for anybody connected with China. I measure the health of the Chinese economy by looking at the Baltic Freight Index, which gives you shipping rates, and they've now been down for 10 straight days. You'd think China couldn't possibly be still so important. It's important for Apple, though, and the Chinese economy, let's say, I don't know how it can get back on track. I don't see it. I'm sick and tired of hearing that it might be stimulus. I've given up on that, in large part because the Chinese Communist Party doesn't seem to believe in the stimulus either. Sometimes I don't want to overthink this. You can tell how much fear there is by looking at what's going higher. Both Procter & Gamble and Kimberly-Clark reported really bad quarters, and their stocks were acting as if both reported blowouts. Abbott Labs lost a court suit last Friday where a jury awarded the plaintiff $495 million as recompense for what the plaintiff claimed was defective baby formula that caused a terrible infant illness. That stock's up huge since then, including about a 4% increase today. You don't get that kind of action when the economy's humming. These are all classic slowdown stocks. Bottom line here, this is suddenly a market that's given to violent extremes. It keeps turning on different segments with a vengeance while rewarding just a handful of others. Today was tech's turn to get mauled by the bears. And with Amazon's revenue miss after the close, the beatdown could continue tomorrow. Although, once again, I think it's selling Apple down huge like it is tonight would be suboptimal decision-making. I need to go to Troy in Florida. Troy.
Hey, Jim Cramer, big fan. I don't always agree with you, but big fan. I'm glad
you're a fan of the show. Well, how can I help?
I wanted to see, what are your thoughts for the next 12 months for Ford Motor Company?
Well, I've got my own reservations about Ford. I've decided to sell it for my charitable trust. They have failed to deliver what I expected them to do. Let's go to Abraham in Georgia. Abraham.
Hey, Jim, how are you?
Oh, good. Sorry if I mispronounced your name. That's my bad. But how can I help?
You said it right. It's okay.
Thank you.
I've been getting information from your show, and it's very helpful. I'm really appreciate it. I just need to know about this CRM.
Sure, and I really appreciate those words. Today's a hard day because both Apple and Amazon report. I really want to try to do a good job for you and all our viewers. It's just very, very difficult. I would say that Salesforce, we trimmed back a little bit because I don't like enterprise. That's enterprise software. But you know what? At 240 is where I would probably say it's okay again to buy. Can I go to Marcus in Oregon, please? Marcus.
Hey, Jim. Thanks so much. Love you on Squawk in the Morning.
Thank you very much.
I'm looking for a shopping list. The week after next is Car Week in Monterey, which is like the biggest, most expensive car show in the world.
Okay.
Thinking about cars. God, I'd love to buy Ford because it looks pretty cheap, but my favorites are still Ferrari and Tesla. What do you think?
Okay, I like Ferrari very much. I think Tesla's much more now. He's trying to feature, Elon Musk is trying to portray it, frankly, as a tech company. If it's a tech company, then I think you can buy it right here and not worry about Monterey. But I thank you for that information. I didn't even know that myself. Let's go to Adam in Georgia, please. Adam.
Mr. Jim, what's going on, dude?
I don't know. Tough night. Trying to understand Apple, trying to understand Amazon, trying to do a good job for you. Sometimes I don't feel I deliver, and I apologize, but I'm doing my best.
Jim,
What's
you're
going
the
on?
Man. You're the man,
no, I'm
Jim.
not the man today. I'm not the man.
Oh.
This is 4 times a year we have this one day, and I cannot deliver what I'd like to do. I cannot deliver the quality product I like to. I'm sure I try. I always try, but it's very tough. How can I help?
Well, we appreciate it. All right, check it out.
Thank you.
I
Thank you.
held Home Depot for 20 years, rolling over my dividends the whole time. And I was wondering, is there anything I can do with that?
I think you just keep doing it. Look, it's got a 2.5% yield. It's got a great balance sheet. When the Fed starts cutting rates, people will start doing more transactions with homes. This stock trades on transactions of homes. When rates go lower, you get more transactions, and that's why it's a good stock to hold. And below 350, I would buy the stock. Look, this market has all of a sudden given us violent extremes. Today's tech turned to feel the pain. And given Amazon's revenue miss after the bell and how no one really is going to care about whether Apple says things are fine, could have some more pain tomorrow. Well, Mad Money tonight. In today's tough tape, there was a glimmer of green in the form of Cummins. I'm hearing how the company achieved record revenue, what lies ahead for the CEO and for the power part of the business, which is really important. Then Travel Trust stock Nextracker reported after the close. And I'm running through the numbers with the company's top brass. I like it. And in times of uncertainty like we saw today, I like to revisit some old school themes. So I'm checking in with the best gold miner there is, which is Agnico Eagle, to see where the state of the precious metal stands. So on a tough day, stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Even on a heinous day for the averages, including the industrials, off a weak manufacturing PMI number, there are still companies that managed to buck the trend. Take Cummins, long one of my faves, the maker of truck engines and power solutions, which soared to a new all-time high today, on like a blowout quarter. The stock finished the day up nearly 5%, but on any of the I think it would be up like 10%. See, Cummins posted an enormous revenue beat, with the company earning $5.26 per share. Wall Street was only looking for $4.83. On top of that, management raised their full-year revenue and EBITDA margin forecast. It was a classic beat and raise, people, hence the rally. How'd they pull this one off? How can Cummins defy a squirrely economic environment and a soft market for freight and Class 8 trucks? Let's go straight to the source with Jennifer Rumsey. She's the chair and CEO of Cummins. Hear more about the quarter and what comes next. Ms. Rumsey, welcome back to Mad Money.
Thanks, Jim. Great to be back with you.
Okay, I've got to tell you, it was a shock. The numbers were so much better than the companies that you sell to. How is that possible? How do you do that?
Well, as you noted, we had a really strong beat in our second quarter earnings call earlier today. Record revenue for the company in the second quarter. You know, really, there's a few factors driving it. Our products are performing really well out in the field. We've been able to take capacity up in some of the places that we've had some supply constraints and meet the demand, and the heavy duty market has held up for us. On the back of that second quarter, we had record revenue and build rates out of our Jamestown engine plant. But other markets are really strong for us as well. Medium duty on highway truck, the pickup truck business. And, you know, one of the standout performers for us was our power systems business, where we're seeing really strong demand in power generation on the back of data center customer demand and other critical infrastructure, backup power.
Well, I think you guys are doing a remarkable job in what you're doing. I also like it. You're taking some of these profits and you're putting them in a lot of new technologies. I think people have often said to me, why are we lagging in battery technology? I think you're going to close the gap with what you're doing, correct?
Yeah, I mean, really, it's a very exciting time for Cummins. While our business is changing, our industry is changing, our Destination Zero strategy, that's really our overarching strategy, having us invest in advancing engine-based solutions and decarbonize those, both higher efficiency diesel and alternate fuels. But we're also investing, as you noted, in some of these zero-emission solutions as the markets start to adopt and as we see customer demand growing. And there's exciting things happening on both sides of those. We're investing at record levels of R&D across our business, and we're also investing in manufacturing $1 billion into our U.S. manufacturing plants for our new Helm engine platforms, and then also investments in battery cell with a new partnership, Amplify Cell Technology, that we form with PACCAR and Daimler Truck and Bus. And then in our own original plant here in Columbus, Indiana, where we're investing not only in the blocks and heads for those new engine platforms, but also in electrified components, including battery packs. So, it's an exciting time and a lot going on. And really, our strategy is playing out for us.
I think you got to explain Helm to people, Helm and natural gas. This is so exciting. It's so great to hear what you're talking about, because obviously you're doing better than a lot of your customers do, but you're also at the cutting edge of pretty much you're agnostic about fuel.
Right. The great thing about our strategy is we have a range of solutions, right? We're watching how the market is moving in some of these new technologies and investing at the right time for different applications. There's not one solution that's going to work for all of our customers. And these zero emission solutions still today, the infrastructure to support them, the cost of operating for those for our customers is a challenge. So these Helm engine-based solutions, Helm stands for high efficiency, low emissions, multi-fuel. Those are a really important part of growing our core business, continuing to have best-in-class engine-based solutions. And then for some of our customers, they want to start moving to these alternate fuels. So this month, we're launching with PACCAR the natural gas, new 15-liter platform. And we have customers that are really interested in renewable natural gas as a way to meet their sustainability targets.
And that, just so people know, RNG actually is that would help for Scope 3 for decarbonizing for many of the big companies that, like an Amazon, that needs that kind of thing, correct?
Yeah, Amazon, Walmart, there's a lot of big companies that have these sustainability goals, and they're running businesses. So what's the most economic solution to meet their needs? What can provide the operating capability that their business needs? And so that's what we're really focused on for our customers.
All right, let's talk about data centers for a second. I know from some of the work that I do with an outfit called RBN, they put out really terrific stuff today, which is that there are certain areas of the country just don't have enough power anymore. And if the data centers want to be there, particularly actually in the Northeast, in Virginia, they just don't have the power. What can you do to ease the power problem for these data centers that desperately need to open up, but the gating factor is power?
Yeah, exactly. So we're seeing a lot of growth in data center as we all have a need for more data storage, AI, Gen AI. This is a trend that I think is going to continue to happen. And having power and having reliable power is critically important for these data center applications. So primarily what Cummins is doing today is providing backup power in the form of our generator set so that they can ensure that they have the power that they need when they need it. And if the grid has any instability or there's power outages, that occur, they ensure they have high uptime for their customers. Okay,
so tell me about hydrogen, which is my favorite fuel, but we haven't had any success. Suddenly you're willing to be in it, which I know is going to be very costly, but so a lot of people say it's the ultimate fuel.
Yeah, we need hydrogen. Hydrogen has to be a part of the answer. And the reason is you've got renewable energy that we need to convert into some kind of fuel, transport, and have it available when we need it. So hydrogen can provide that way to store renewable energy, transport it to where you need to have that fuel. Secondly, in certain applications like a heavy-duty truck that's very weight sensitive, is traveling across the country and has high power, long range, batteries are too expensive, too heavy. They just don't work for that application. So we need hydrogen-based solutions, and we're investing today in hydrogen engines. So we'll be able to burn hydrogen, these Helm engine platforms, and then also in fuel cells. I think this is going to be a little bit farther out. The reality is, hydrogen is going to take some time to develop, but we're advancing those technologies. And then, of course, we're also in electrolyzers for hydrogen production. And that's a business that we see developing sooner, although it has slowed somewhat from what we'd originally projected. And if you go back to our Analyst Day in May, we took up the guidance for the company overall in terms of revenue and cash flow, but we did lower expectations in 2030 for that Accelera business and raise them in our core business just based on how this transition is playing out.
All right, well, one last question I have. I was listening to almost every single trucking company call, and with the exception of one that actually just reported, almost all of them have been talking about a freight recession. I'm trying to figure out how to jive what you've done, which I used to think of you as a truck engine company, with what they're saying. And is there just some sort of disconnect? I don't get how you could have such a great quarter when they are saying things that really aren't that positive.
Yeah, well, first, Cummins is a diverse business, so we're in things besides heavy-duty trucking. We are projecting heavy-duty trucking to be down for the year 7 to 12%, predominantly in the second half. So we had that benefit of back orders and strong demand and the product performing really well in the market. And the applications like vocational, there's been strong demand in vocational where Cummins is a really strong player. So that really benefited us through the first half. We're projecting to be down 20% in the heavy duty market in the second half. Some of those other Cummins markets, so like medium duty, and that power gen market, are going to stay strong for us even into the second half of the year.
You've got the great mosaic. It's not like the old days. Really fantastic work. I want to thank you, Jennifer Rumsey, Chair and CEO of Cummins. It's so good to have you on the show. Really great. Thank you.
Thanks, Jim.
Mad Money's back after the break.
Coming up, where does Nextracker stand as the world races to decarbonize? Cramer's getting the latest on the impact from Washington, the data center build-out, housing market, and more with the CEO. Next.
All year, I've had my own Nextracker, a technology company that helps the solar industry operate more efficiently. They allow your solar panels to rotate with the sun, maximizing the power generation. This is a stock that's nearly doubled from its IPO price early last year, although lately it's pulled back from its highs as Wall Street's turned against growth stocks. But because Nextracker is all about utility-scale solar projects, the stocks perform much better than the other solar plays. Those were the ones that were dragged down by weakness in residential solar, and that's why we bought the stock for the charitable trust. Tonight, Nextracker reported yet another blowout quarter. Big revenue beat, 29-cent earnings beat off a 64-cent basis. All the real negative is the management didn't raise their full-year forecast for the current fiscal year and spoke about some new projects being delayed that could constrain earnings, and that's why the stock got hit in after-hours trading. Earlier today, we checked in with Dan Sugar. He's a.k.a. Shug, as we call him around here, the co-founder and CEO of Nextracker, to get a better read on the results. Take a look. Shug, congratulations and welcome back to Mad Money.
Jim, thanks for having us back on the program.
Well, we're thrilled that you're here. We know that this was another great set of numbers, starting right at the top of 50% over year-over-year revenue growth, $100 million top-line beat. What were the drivers here that made this happen?
Well, Jim, we really are optimizing our business annually and really seeking to always meet our customers' schedules. And so strong prior bookings, customers wanting material we delivered, and had a 50% growth year on year in our top line.
Can you tell me and our viewers about the benefit of tax credits so they understand? Because obviously they're bountiful. I think you do well without them, but I do want people to understand how they work.
Sure. Well, we operate globally. We're in over 40 countries today, Jim, and different countries have different tax regimes. In the U.S., there's a 30% investment tax credit that most of our customers enjoy, and that's really helped equalize the playing field because fossil fuels and other ways to generate power receive their own benefits.
But we do know from what you've been saying to us, at least by 2030, that solar will be so compelling that we don't really care what nat gas does or what oil does. It's just going to be that much of a price differential because of the technology, because of what you do.
You know, it's really amazing how much cost reduction has been sustained in solar over the years. To give you a sense, about 15 years ago, we did the largest solar power system in the country then, and that was over $7 a watt in that year. And costs have come down by about a factor of 10. And it's because of the economies of mass production and the learning curve effect that solar's enjoyed such an incredible cost reduction. And that's why solar, which is really a semiconductor technology, is displacing traditional fossil fuels in the same way that computers replace typewriters and digital film or digital cameras replace film. It's the same exact disruptive technology.
So at the same time, this is, I think, you demonstrated by your backlog, which seems gigantic to me.
We did enjoy, Jim, this quarter an increase in our backlog, and that was in the context of a very strong revenue quarter. So the fundamentals for solar have never been stronger because solar is the lowest cost way to generate power on most of the earth. And so we've seen places that you wouldn't necessarily expect solar to be taking off. For example, in the U.S., places like Indiana, Michigan, we're seeing solar projects in most of the states across the U.S. We're seeing solar projects very strong in Latin America, Australia, Africa, the Middle East, India, And so we're engaged, Nextracker, in all these markets serving customers.
Okay, if that's the case, then I do have to wonder why you're just reiterating your full-year guidance. This quarter is so big that I wouldn't guide up in my first quarter either. And I know you do have an election coming up, which could play a role. But are you just being conservative? Because otherwise, straight line this thing, and you would have to take your numbers up pretty big.
Yeah, our fiscal year is young, Jim, and we're going into this. The one thing that is true is it does take longer for projects to get fulfilled. Projects, our experience, don't die, but sometimes it takes longer to get a construction permit or to get permission to connect to the grid. There's so many solar projects that have applied for connection to the electrical grid. If you look around the United States, over 7,000 projects, solar and solar plus energy storage projects have applied to be connected to the grid. That represents 80% of what we call the interconnection queue. So the utilities are figuring out ways to streamline their process to evaluate these applications and interconnect. That's one of the largest factors in actually practically hooking up these projects. So our customers' projects can move in as they did to an extent this quarter that we just finished, which is why we had such a strong quarter, or in some cases they can take longer than anticipated. And so going into this year, that's how we decided to reiterate our guidance.
Understood. Now, there are a lot of people who don't understand. You talked about the vectors, what could matter. What do you think is the sensitivity of your business to interest rates? We know the residential turned out to be an interest rate play. No one thought that. But your company is not as directly impacted by rates.
Right. Well, utility scale solar, and thank you for differentiating that in your opening comments, has really powered on and is doing extremely well as a category. But I'm glad you pointed that out. The economics of solar are the number one factor that can help drive more utility scale solar are lower interest rates. And so because with renewable energy like solar and wind, most of the cost over the life of the project is right up front. And that gets amortized out. There's no fuel. Maintenance is very, very low as a cost item. So we're hopeful that the Fed does lower rates. We saw some promising signals to that yesterday, but we'll let the government do its jobs. But we're hopeful that rates do start to come back down, and that would be a very strong help to utility scale solar as a category and for Nextracker.
Well, excellent. That's what we wanted to know. And it is a pleasure to have you on, Shug. And obviously, this is just still one more very good quarter. Thank you for coming on to Mad Money.
Thanks a lot, Jim.
Absolutely. That's Dan Sugar, founder and CEO of Nextracker, stock that we own for the Chapel Trust. You obviously know I like very much. Mad Money's back into the break.
Coming up, Agnico Eagle's shiny quarter beat analyst expectations. Cramer's got the CEO to dig deeper into the numbers and get an outlook for gold. Next.
This market's gotten so crazy that you may have missed it when the price of gold briefly broke out above $2,500 an ounce today. That's an all-time high. And that means it's time to check in with some of the gold miners like Agnico Eagle Mines, which reported last night. These guys delivered a solid quarter with better than expected production, lower than expected costs, which is exactly what you want from a gold miner. It led to the third straight quarter of record cash flow. Yet despite these impressive numbers, the stock still fell 1.5% today. Oh, I think that's mainly because it was up 45% for the year going into the quarter, and people were looking for any excuse to maybe take a little profit. Let's check in and get a closer look with Amar Al-Jundi. He is the president and CEO of one of the great performing mine companies of our era, Agnico Eagle Mines. So learn more. Mr. Al-Jundi, welcome to Man Money. Good to see you.
Thank you, Jim. Longtime fan. Great to be on your show.
Thank you. Thank you. I love your company because it makes the numbers. It gives back in the dividend, and there are no surprises. Isn't that really what we want out of a gold miner these days?
That's exactly right. That's we like to consider ourselves the sleep well at night gold stock.
Well, I think that people have to understand that there are a lot of things that can go wrong with gold, a lot of mistakes, and yet what you've been able to do is keep your costs down. The differential between what you're able to get in the gold market versus what it costs all in is probably one of the biggest increases I've ever seen of any miner.
Yeah. You know what? If you take our cash costs and you add on top of that the sustaining capital, Jim, our margin's still over 50%. So that's fantastic. We generated over $500 million of free cash flow this quarter alone.
So will you take some of that money and go into what sounds like one of the best mines in the world, Detour Lake Mines, which is in a very safe area of northeastern Ontario?
It is absolutely one of the best mines in the world. We are planning to get Detour to over 1 million ounces a year. Jim, that is one of the top 5 gold mines in the world. And when you look at the jurisdiction, it is arguably the best gold mine in the world.
Now, how about Upper Beaver, another one that you're highlighting that sounds like it could be very big?
Upper Beaver is a great mine. It's in our backyard. It's not a complex mine. It's a very low cost mine. When we bring it in, it'll have cash costs below $600 and all-in sustaining cost with capital about $750. So the margin on that is pushing 65-70% based on our forecast and compared to spot price.
Well, that's fantastic. We're gold bugs. I've been a gold bug forever, and Costco did something really fabulous. They let us buy gold and not don't jack it up. And the demand, you couldn't get it. It was every single morning. It was gone. The desire to have gold may be much bigger, I think, than desire to have crypto at these levels. Are you seeing that maybe at last people realize that it's really hard to find gold? It's not like every year you find 10% more gold than there was the year before.
You know what? All of the mining companies combined globally, we had about 2%. That's it. And I got in this business, Jim, and I have been a long time fan, and you have been a long time supporter of gold. I got in this business in 1999. Gold was $280. It's up, as you mentioned, by a factor of 9. And people have hated it all the way up. But it's been a fantastic performer. And it's been a fantastic performer for probably some bad reasons, right? Government expenditures. We can go on and on. But all the things that moved gold, in my opinion, from $280 to $2,500, they're still there, and they're going to continue to still be there.
Well, I think you're too modest, sir, because one of the reasons why gold has done so gold companies have done so poorly while gold has gone up is that a lot of them just overpromise and then they underdeliver, maybe because they're in different places or they misjudge the labor costs, or they misjudge the electricity costs, they misjudge COVID, they misjudge jurisdictions. You don't have any of those problems. You just deliberately just say, listen, we're only going to go in areas where we have total control of the costs.
Yeah.
And that's it.
You nailed it. You nailed it with the word misjudge. Frankly, look, it's hard to go into tough jurisdictions on the top of a mountain range in a place you've never been before and make solid predictions. The difference with Agnico Eagle is we don't do that. We don't consider ourselves a global mining company. We understand the logic behind that, but that's not us. What we are, Jim, is a regional mining company. We go into regions that, of course, have geologic potential for multiple mines over multiple decades. But importantly, we only go into regions where there's the political stability to actually operate multiple mines for multiple decades. And so when we are giving guidance, we're giving guidance about projects in our backyard where we've been operating for decades. You mentioned Detour. That mine's been around since the 80s. You mentioned Upper Beaver, we're going to build it. That's in our backyard. We've known about that asset for decades. So you're exactly right. We've had a better track record of delivering, but I have a huge advantage versus many of my peers, which is we operate in regions we know well. And usually when I get information, I have a big advantage in the accuracy of that information, frankly.
Well, then you might be able to help me with a prediction. I usually don't ask the miners to do. It's not fair, but I mean, do you think with the way things are going with the budget deficit in the United States, the way things are going with the actual demand to want the metal, that it can just continue to outperform here and continue to go higher?
I'm going to say something a bit odd. I'm 100% sure it'll go higher. I don't know where it's going to go. I know that's a strange thing to say. I don't know where it's going to be next month. I don't know where it's going to be in 6 months. But all of the reasons gold has gone up over the last 25 years by a factor of 9, government spending, uncertainty, people wanting to put their money in safe places. Add to that now central banks around the world thinking, hold on a second, I'm buying all these US dollars in a case I need it for liquidity, but I can be out of the SWIFT system in 24 hours. These are not good things, but they are constructive for gold. And as the CEO of a gold company, I'm constructive on gold, ironically, for bad reasons.
No, I think you're literally sitting on a gold mine, sir. Thank you. Thank you very much. I totally agree with you on everything, and you know that. That's Amar El-Jundi. He's the president and CEO of Agnico Eagle Mines, which is the best gold miner in the world. Thank you, sir.
Thank you.
Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time for the lightning round. Chris Reyes, Rob Goldman, I'm going to tell you to buy, sell, so sell, just go to know the core stock questions at a time. My staff prepares to play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Chris Reyes, let's go to Jeff in Kentucky. Jeff.
Yes, booyah. Wondering what your take was on
Wells Fargo. Okay, Wells Fargo, you know that Jeff Marks and I, we literally discussed pulling the trigger today and buying some Wells. It's down way too much from where we sold stuff, but we don't want to play that hedge fund game. I think Wells should be bought right here. Jerry in Missouri. Jerry.
Hey, Jim, thanks for taking my call.
Absolutely. What's going on?
I want to thank your staff for getting me on the call today.
Absolutely. They're fantastic.
My stock is, I want to know if my stock is going to rebound to its previous levels or if it's just going to be a battleground stock forever. I'm asking about CrowdStrike.
Okay, I think it'll be a battleground stock. I don't want to say forever. And the reason I say that is because SentinelOne, Tomer Weingarten, who I welcome on the show, but come on, just had some horrible things to say about its competitor, CrowdStrike, and it drove the stock down to another level. So I want to wait till that clears up before I would wade in. Let's go to Scott in Connecticut. Scott.
Big old booyah, Jim.
No problem. What's going on?
Here. I remember watching you on the television in my father's office as a teenager, and now I'm watching you for advice on my own portfolio, and you're still doing it. It's incredible.
Yeah, I mean, when your grandkids are going to watch the show, they'll love it. I'm going to change it up a little bit. Maybe we do a longer lightning round. How can I help?
My question is on AST Space Mobile, stock ticker ASTS. I bought in at $4.53. The stock has literally rocketed up to 20.
Wow, man, you got horse sense. Here's what I would do. Tomorrow morning, take out your cost basis and let the rest run. And that way you'll never give back anything. That's the way to play it. Let's go to Ian in Florida. Ian.
Booyah, Jim.
Booyah.
Greetings from sunny Florida.
Okay.
Third-time caller and a very happy investing club member. Want to thank you for all the great advice.
Thank you
Jeff
very much. Thank you.
Really appreciate it. Really appreciate it. Jim, I got a question about a ticker that is kind of a part of the semiconductor trade. Good numbers, very profitable, and pretty much everyone has to go to them if you want to do semiconductors. But there's a lot of geopolitical risk with it. The ticker symbol is TSM, Taiwan Semi.
Taiwan Semi, there is political risk. I am not going to overlook the political risk, but I can tell you it's a great company. I do think that when all the smoke clears, that NVIDIA will have a lower price earnings multiple, and you should buy NVIDIA instead of Taiwan Semi. Let's go to Tim in Michigan. Tim.
Hey, Jim. I wanted to know your opinion on Tyler Technologies right now.
It's a very, very good company, management solutions company, and I have explored this company 9 ways to Sunday and have never pulled the trigger, and that is my bad. It's a really good company with a stellar reputation. Let's go to Brian in New York. Brian.
Yes. Hey, Jim, how are you?
I am good. How about you?
Good. Everything's good here.
All right. What's up?
I'm looking at CMEX. Call sign is CX.
Wow, that's a dice roll. I got to tell you, I have no conviction in that company whatsoever right now. I'm sorry. I'd like to back it, but it's a dice roll. Let's go to Paul in Connecticut. Paul.
Hi, Jim. Lumen Technologies. The stock price has gone parabolic in the last 3 days.
When we see parabolic moves, we cut our position in half. We let the rest run. That's what you're going to do tomorrow morning. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Meta AI's spend weighed on the stock after earnings. But could what the market overlooks today transform the world tomorrow? Cramer is giving his take next.
Buzzkill. I'm talking about the total wet blanket that fell on Meta platforms. They've reported a truly remarkable quarter last night. It's easy to overlook the artist formerly known as Facebook as an outlier, a company with the good fortune to have more than 3.2 billion users across its family of apps. With that many eyeballs, it's pretty hard not to make a lot of money, isn't it? Okay, that's true. But there's a lot more going on here, including the first example I've heard of a company using artificial intelligence at scale to do something that's visible, valuable, and obviously useful that saves companies money. Mark Zuckerberg, out of nowhere, has unveiled a service, Meta AI, that's challenging incumbents ChatGPT, Gemini, and Claude 3 for the best AI chatbot service. Given that it's linked to Meta's family of apps, it's incredibly easy to use. You can toggle back and forth very easily on your cell phone. If you compare questions and answers, I think it's authoritative and easy to use compared to the others. But more important, it looks like Zuckerberg's spending a lot of money, and I mean a huge amount, to install video wherever it might be best used, perhaps embedded in Meta AI. Video is key. It's sticky. It's loved by users, and advertisers just can't get enough of it. Here's how Zuckerberg described this use case straight from the conference call, and I'm quoting. It used to be that advertisers came to us with a specific audience they wanted to reach, like a certain age group, geography of interest. He goes on to say, eventually we got to the point where our ad system could better predict who would be interested in the ad than the advertisers could themselves. Right now, the advertisers are still developing their own creative, though. Zuckerberg says that's going to change. Listen to this one, quote, advertisers will basically just be able to tell us a business objective and a budget, and we're going to do the rest for them, end quote. Think of the implications. The chief marketing officer of a consumer packaged goods company that spends hundreds of millions of dollars on advertising with agencies each year will just cut out that middleman and tell Meta directly what it wants. And that's it. Send them a check. Go and be all the people who develop creative and place the ads. Alas, we're about to automate Don Draper out of existence. They'll be regarded as useless friction in no time. I don't know how you beat that. It's a terrific use case. It's incredibly additive to earnings for any company that uses Meta instead of the traditional ad agencies. I point this out because if you didn't read the Meta call and you looked at the meltdown in the NASDAQ today, you think that artificial intelligence is probably a gigantic joke, a bubble that's clearly bursting. But to me, this is the first time I've heard some concrete use case for AI that will most certainly change the world, or at least the business world, which is good enough. I bet plenty of companies will stop advertising anywhere else except for Meta. It's got 3.2 billion users, much larger than any television program, and Meta now has the machines to create and place those ads too. Now, the mega caps like Meta are so big that they can do things, real things, and it doesn't even matter. Meta has these smart Ray-Bans that can post your pictures, follow up on your thoughts with AI. You see some commotion in the street, ask them what's happening at that address where you are, and they'll come back with an answer. EssilorLuxottica, the company that makes these sunglasses, cannot keep up with the orders, according to Zuckerberg. For any other business, that'd be a big deal. But for a member of the Magnificent Seven, too small to move the needle. I know that we'll remember today as a day where everything but the drug stocks and some other staples rolled over because of the 10-year Treasury, like I mentioned at the top. Maybe we should remember it as the day when we learn that a whole gigantic industry is about to be turned upside down by AI. Nobody cares today. I bet they'll care a lot a year from now when Zuckerberg's vision becomes the reality. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.